Stop. Do not let them convince you that a pause is the same as a reversal. Do not let an analyst's caution about stretched momentum make you commit the one mistake that will cost you the most in this entire cycle. I know what you are feeling right now. Silver hit $82.46 on Tuesday, March 3rd, a brutal $11.80 single-day collapse from Monday's peak. You saw the headline. StoneX says overbought. Due for a break. And now the voice in your head is screaming, get out. That voice is wrong. It is Wednesday, March 4th, 2026. Silver is trading at $85.64, already recovering 3.84% from Tuesday. Ladies and gentlemen, Silver Analyst here. What StoneX actually said, the full message, is not what the headline wants you to believe. Silver is heating up, and this move could surprise the market. Let's break down what's happening right now. If you want clear and powerful silver market updates, make sure to like, subscribe, and follow Alex Carter Reports for the latest analysis. Let us begin with what StoneX actually said, because the headline version and the full version are two entirely different pieces of intelligence. Rona O'Connell, head of market analysis for EMEA and Asia at StoneX, and a recognized authority in precious metals with over 4 decades of market observation, published her weekly precious metals assessment on March 2, 2026. According to reports citing the StoneX weekly analysis, her precise conclusion reads as follows: gold and silver may have done enough for now and need to unwind overbought conditions. But the downside remains limited. Barring further geopolitical escalation, it is time for a breather. Read that again. The downside remains limited. That is not a crash warning. That is a compression forecast. A breather is not a breakdown. A pause is not a reversal. The distinction between those two words is worth tens of dollars per ounce to anyone who understands it and acts accordingly. Now let us overlay what the technical structure confirms. As per the StoneX weekly report, silver is currently sitting on a 61.8% Fibonacci retracement level following the enormous corrections of January and early February. The 61.8% Fibonacci retracement is one of the most powerful support levels in all of technical analysis. It is not an arbitrary number. It derives from the golden ratio, the same mathematical proportion found in natural growth spirals. When a metal in a genuine bull cycle pulls back to this exact level and holds, history confirms it as the highest probability reload zone in the entire structure. Now look at what the price actually did. Monday, March 2nd, silver peaked intraday at $96.40. Tuesday, March 3rd, the metal collapsed to a session low near $78.13 on futures, a violent swing of more than $18 in under 48 hours. At the New York Open on Tuesday, spot silver traded at $82.46, confirming an $11.80 single-session decline per market data. Then Wednesday, March 4th, today, silver opened recovering. Market trackers confirm the metal is trading at $85.64, up 3.84% from Tuesday's $82.48. Think about the anatomy of that price sequence. $96.40, then a violent compression to $78, then an immediate recovery back through $85. That is not a market that is dying. That is a market absorbing maximum panic and then bouncing off structural support. The left shoulder of the broader right shoulder formation sits in the low 80s. The head was the all-time high of $121.66 reached on January 29th. The current price action, the violent oscillation between 78 and 96, represents the compression zone of the right shoulder. The neckline breakout target remains the $92 to $93 zone. Every session that silver holds above the Fibonacci 61.8% support compresses the spring further. The gold-silver ratio, according to reports sourcing StoneX's weekly data, currently stands at approximately 57 to 1, having narrowed through the second half of February. When the ratio contracts, silver outperforms gold. When it expands during pullback phases, it creates the entry window. Right now, the ratio is in that oscillation zone that historically precedes silver's outperformance leg. The market is breathing, and when it finishes exhaling, the next inhale will be the one that matters. Now let us examine the hidden structural data inside the StoneX caution call, because the same weekly report that warned of stretched momentum also revealed a supply dynamic that most readers skipped entirely. According to market intelligence from StoneX, COMEX silver inventories currently stand at 11,207 tons, down 5,323 tons from the end September peak level. Analysts note this inventory level is approaching what the research team describes as the more normal 9,000 to 10,000 ton range. Think about what that sentence reveals. The COMEX system spent months absorbing extraordinary inventory inflows driven by tariff arbitrage and speculative positioning. That swelling is now normalizing. The excess metal that had been artificially warehoused is draining back toward historical equilibrium. This is not bearish for silver's long-term trajectory. It means the distortion is unwinding. When the distortion fully clears, the genuine underlying supply deficit reasserts its grip on the price. The commitment of traders' positioning data adds another layer of structural intelligence. As per the latest Sicote analysis, large speculator net long exposure in silver futures has contracted to a near 2-year low of 22,000 contracts. Gross longs dropped to a 13-year low of 32,500 contracts. Gross shorts sit at a 13-year low of 10,200 contracts. Intelligence suggests managed funds edged their net long exposure higher to 8,500 contracts, a 5-week peak. Analyst commentary confirms this positioning does not reflect strong conviction behind the rally, and confirms that large speculative desks are stepping back rather than chasing the move higher. Now here is the contrarian read on that data. When large speculators reduce exposure to a multi-year low in a metal that has a 67 million ounce structural annual deficit, the implication is not that the price collapses. The implication is that the market is leaning on physical demand, not speculative leverage, as its primary floor. Physical demand floors are structurally more durable than paper-driven floors because they cannot be margin called. A physical buyer in the solar supply chain does not receive a margin call when the price drops $8. They receive an invoice and they pay it. That is a different and far more durable kind of demand. And the macro environment is about to be tested by 5 consecutive catalysts in 2 weeks. As per the economic data calendar, March 4th brings the ADP Private Sector Jobs Report, ISM Services PMI, and the Federal Reserve's Beige Book. March 6th delivers the Non-Farm Payrolls Report. March 11th brings U.S. Consumer Price Index data for February. March 13th delivers the U.S. GDP second estimate and University of Michigan inflation expectations. March 18th, the Federal Reserve's interest rate decision. 5 data releases, 1 rate decision, all within 14 days. If even 2 of those prints show economic softening, labor miss, slowing inflation, or GDP disappointment, the dollar retreats and silver's structural foundation becomes the launching pad. Analysts note that the biggest near-term downside risk for silver would be something that challenges the broader precious metals rally, specifically a materially hawkish shift by the Federal Reserve, but sources also confirm that silver will re-engage structurally once the speculative excess from recent prices has been fully eliminated. That elimination, the $82 Tuesday session, the $78 futures intraday low, may be exactly the shakeout analysts anticipated. The tourists paid for the cleanup, the diamond hands inherited the position, and consider what the India physical market is revealing. Reports from March 4th confirm that silver in India retreated to 294,900 rupees per kilogram, pulling back from the 315,000 rupee peak earlier in the week. That retreat is not demand destruction. That is India buying the dip at a lower price point. A country that imported 190 million ounces of silver in 2025, 25% of global annual supply, does not walk away from a pullback. It accelerates into it. Physical demand in the world's largest import market for silver does not require a technical indicator to give permission to buy. It requires a price that is lower than the previous price. And right now the price is lower. Here is what is happening inside the heads of the 2 armies fighting over silver right now. Understanding both sides clearly is the difference between the trade that prints and the trade that stings. The first army is the momentum crowd. These are the traders who entered silver at $90 or above during the Monday geopolitical surge. They bought the headline Middle East escalation, safe haven demand, war premium. They saw $96.40 on the screen, and concluded the train had left the station without them. So they boarded late, and when Tuesday printed $82.46, their stops triggered, their positions liquidated. They became the fuel for the downside move, the involuntary sellers who funded the gap between 96 and 78 on the futures board. They are gone now, and the metal is already recovering without them. The second army is the structural holders. These are the stackers, the industrial procurement desks, the ETF managers, and the institutional funds that built positions at $60, $70, $80 over the past 18 months. When Tuesday printed $82, they did not see a loss. They saw a discount. Their average cost basis sits far below current prices. They have no stop losses to trigger. They have physical metal in allocated vaults. Community trackers confirm these holders absorbed the Tuesday sell-off and are sitting patiently while the price recovers toward $85 on Wednesday morning. Now look at the broader market backdrop amplifying silver's volatility without changing its fundamental direction. Reports confirm Asian equity markets are falling sharply, the MSCI Asia-Pacific Index declining up to 4% on Wednesday. South Korea's Kospi Index has fallen 10.71% near 5,170, with the Korean won weakening past 1,500 per dollar. These are significant dislocations. They signal that geopolitical risk is not fading, it is morphing into a new market baseline. Capital is rotating away from equity risk and toward cash and hard assets. Silver may be oscillating violently in the near term, but it is oscillating within a context where the macro tide is moving toward real assets, not away from them. The gold-silver ratio oscillation, expanding from 59.24 on Monday to 62.43 on Tuesday, then narrowing again Wednesday as silver recovers faster than gold, is a sentiment thermometer. When the ratio widens sharply, fear has shifted toward gold as the purer liquidity safe haven. When it narrows, silver's dual identity as both monetary metal and industrial necessity reasserts itself. Sources suggest every meaningful ratio expansion toward 60 or above during the current 2026 cycle has been followed by days of silver underperformance and then weeks of outperformance. The ratio is in that setup now. The question for the community is not whether StoneX is right about the need for a breathing phase. They are right. The question is what you do during the breathing phase. Weak hands sell during the exhale. Diamond hands accumulate during the exhale. And when the lungs fill again, when the next ADP miss, NFP disappointment, or CPI softening triggers the next dollar retreat, the diamond hands will be positioned. The weak hands will be watching from the sidelines, waiting for a confirmation signal that never feels comfortable enough to act on. That is the eternal tragedy of the tourist in a structural bull market. They need certainty. Certainty always arrives after the move. Let us now address the bear case directly, because the StoneX warning deserves genuine intellectual engagement, not dismissal. O'Connell and her team carry decades of combined institutional precious metals experience. When analysts say the market needs to unwind, they are identifying a real technical condition. The RSI on gold, as per the StoneX assessment, was approaching 70, the threshold that historically defines the boundary between momentum and overextension. That is a legitimate caution signal. It should not be ignored. But here is what the bear case cannot explain. If gold and silver are simply victims of overbought momentum unwinding, if this is a purely technical correction in a market that rose too fast, why did gold retreat to $5,118 on March 4th, while the MSCI Asia-Pacific Index simultaneously fell 4%? In a normal technical correction, risk-off assets like gold hold steady or rise while equities fall. But gold is pulling back alongside equities. What does that tell you? It tells you the correction is dollar-driven, not structurally driven. A surging dollar compresses everything simultaneously. Equities, metals, commodities, bonds. When the dollar eventually softens on a labor miss or a policy pivot signal, everything rises, but silver rises fastest because it carries the dual engine of monetary hedging and industrial necessity. Now compare silver's current position to what analysts expect as the re-engagement trigger. Sources confirm that re-engaging silver makes structural sense once speculative excess has been cleared from the market. Tuesday, March 3rd, printed $82 spot at New York Open. That represents a 32% correction from the all-time high of $121.66. 32%? In what other major asset class would a 32% pullback from the all-time high be described as froth still remaining? When crypto sheds that kind of percentage in a weekend, the community declares the bottom and accumulates. When silver absorbs it from a genuine physical deficit structure, the same community questions whether the bull market is over. The double standard is not a warning. The double standard is the opportunity. The geopolitical backdrop is also structurally unchanged, regardless of what any technical analyst says about momentum conditions. The same StoneX report that issued the overbought warning simultaneously confirmed that the strength in gold and silver should be sustained until conditions settle down, and that markets remain in risk-off mode. That is the full context, not just breather, but sustained within a risk-off structure. Conditions have not settled. South Korea's Kospi is down over 10%. Asian equities are losing 4% in a single session. Shipping disruptions in the Hormuz corridor continue to elevate energy and commodities risk premiums globally. The IAEPA tariff litigation explosion following the Supreme Court ruling adds policy uncertainty that historically fuels precious metals demand. The war premium is not a temporary spike that fades on a ceasefire call. It is embedding itself as a structural layer in the global risk architecture. And silver enters this environment with a 67 million ounce annual deficit confirmed for 2026, the sixth consecutive year of physical undersupply. No technical overbought reading changes that number. No dollar strength changes that number. No COT positioning changes that number. The deficit is geological and industrial. The mines cannot be built overnight. The solar and EV demand pipeline cannot be rerouted by a data print. The AI data center expansion consuming silver and thermal management and advanced electronics does not pause because an RSI reading is elevated. When the momentum froth clears and the structural bid reasserts itself, the price will reflect the physical reality underneath the paper noise. And the physical reality says the world needs more silver than the world can produce. That is not a headline. That is a balance sheet. And balance sheets always win in the end. Let us now build the battle plan for the next 14 days. Because the next 2 weeks are not quiet days. They are the 5-trigger gauntlet, and every trigger has the potential to decisively move silver in one direction. The immediate zone, $82 to $86. The structural base, this is your primary accumulation battlefield right now. Silver opened Wednesday at $85.64, recovering from Tuesday's $82.46 New York spot. The band between $82 and $86 is where StoneX has identified the Fibonacci 61.8% retracement support. It is where the 50-day and 200-day moving averages converge. It is where the institutional reload zone sits. If silver consolidates in this zone Wednesday and Thursday, it is building the base for the next directional move. A daily close below $81 shifts the probability toward a deeper retest of the $78 futures floor. A daily close above $86.50 begins the recovery arc toward 90. Catalyst 1. ADP March 4th. The dollar decision. The February ADP Private Sector Employment Report publishes today, March 4th. The market expects 50,000 jobs, more than double January's 22,000. According to reports, if February prints at or below 30,000, the dollar weakens on Fed cut expectations. Silver runs toward 90. If February beats 50,000 significantly, dollar strength resumes, and silver tests the $82 zone again. Same day also brings ISM Services PMI. A services miss doubles the dovish pressure on the dollar. Catalyst 2, NFP March 6th. The weekly verdict, non-farm payrolls on March 6th will be the single most important data print of the week for precious metals direction. According to the economic calendar, this is the primary labor market gauge, with government shutdown delays having impacted earlier data. A weak NFP, consistent with January's 22,000 ADP print, confirms labor market softening and accelerates rate cut pricing into the March 18th Fed meeting. Silver above $90 by Friday session close becomes the primary scenario in that outcome. Catalyst 3, CPI and GDP March 11th and 13th. The inflation double. March 11th delivers U.S. Consumer Price Index data for February. A softer CPI print, showing inflation decelerating, collapses the hawkish Fed narrative and detonates the dollar's primary support pillar. March 13th adds the U.S. GDP second estimate. Sources confirm that if fourth quarter GDP revises lower, the stagflation signal intensifies. Stagflation, slowing growth plus sticky prices, is the environment where silver has historically outperformed all paper assets simultaneously. Catalyst 4. March 18th Fed decision. The rate verdict. The Federal Reserve's rate decision on March 18th is the culmination of the entire two-week data cycle. If the preceding calendar delivers a labor miss, a CPI softening, and a GDP revision lower, rate cut probability reprices upward. Any surprise toward accommodation, even a dovish statement shift, is explosive for silver. Intelligence suggests markets are currently pricing only minimal probability of a cut at this meeting. But that probability is not fixed. It moves with data, and the data calendar starts moving today. The prediction. 2 scenarios. One direction scenario. 1. Data softens this week and next. Silver reclaims $90 before March 18th. Neckline breakout at $92 to $93 becomes the primary target. Path toward 100 opens in the first 3 weeks of March. Scenario 2. Data beats consensus. Dollar holds, silver consolidates between 82 and 88. StoneX's breather extends another week. This is not a failure. It is the accumulation window. Diamond hands in the building when the explosion arrives. What does your scenario read say? ADP comes today. Drop your prediction in the comments. Are we back above 90 by Friday? Let the community speak. Stay stacked, stay sharp. Silver Analyst here. See you at the next level. That's it for today's silver update. The market is setting up for a potential big move, so stay alert and stay prepared. If you found this analysis helpful, don't forget to like the video, subscribe to the channel, and turn on notifications so you never miss an update. This is Alex Carter Reports, bringing you clarity in every market move. See you in the next one.